Investing in the stock market is one of the most popular yet easiest ways for nearly anyone to build serious wealth over time. In fact, a janitor secretly amassed an $8 million fortune from the stock market, where he left most of it to his local library and hospital. But if you don't know how to invest in stocks, you could be in for some serious trouble, and I say that because the research shows that the vast majority of retail traders lose money, where data shows about 90% of investors lose money trading stocks, which includes both new investors and seasoned professionals. So after constantly researching and investing in the stock market for 8 years and creating all the content that I do, if you watch this video until the end, I have no doubts that it will be beyond worth it for you down the road. Knowing that, to get straight to it, let's first go over what are stocks. When it comes to buying stocks, and I'm not talking about the Christmas stockings, this means that you are able to invest your money into a company to receive a small ownership of that company. For example, if you were to buy stock in the company Apple, that means that you are a part owner of the company. It's a very small percentage with a company that big, but if the company does very well and Apple stock were to increase, go up in value, then so would your investment, and that means that you would make money. To see exactly how this works, let's say that you bought one share of Apple stock in January 2024, where the price was $185. If you held onto that stock throughout the entire year of 2024, that means your $185 investment by the end of the year would now be worth $255, making that an increase of $70, which is roughly 37% growth in just 1 year. May not sound like a lot, but if you were to invest $10,000, that means your investment would have made you nearly $4,000 in that 1 year alone. But understand that having an investment grow 37% in 1 year is rare and insanely difficult to do, especially across an entire portfolio of diversified stocks that you're invested into over a long period of time. To give you a better understanding, the S&P 500 index since 1957 has averaged an annual return of just over 10%. If you don't know what the S&P 500 is, it's pretty much a way to invest into 500 of the largest US-based companies, all within one purchase. And although betting your money on one stock like Apple may provide you a significantly higher return, it's reported that only 22% of stocks in the S&P 500 have outperformed the index from 2000 to the year 2020. And not just that, but it's reported that 89% of fund managers as a whole failed to beat the market, referring to the S&P 500. Understanding this fully is extremely important because instead of investing all your life savings on one company hoping that it will do extremely well, having diversification along your investments will reduce significant risk, yet still provide the opportunity to actually build wealth over time. In fact, one of my favorite quotes from one of the best investors of all time, Warren Buffett, is when he said, by periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. So to emphasize the importance of index funds like the S&P 500 as the foundation to a portfolio, here is exactly why to consider index funds. So to first clear any confusion, an index fund in simple terms is a collection of different items that are on a list that you can put your money into, and when you buy it, you are able to own each of those items that are on that list, but it's all within one purchase. A real world example that I thought of when creating my Fidelity Index Fund video 2 years ago is that when you finish buying groceries, you get a receipt of all the items that you just bought. The list is going to have different prices for every item, so you may see chicken as $15, strawberries could be $5, milk could be $3, and whatever else you bought. But understand that all these items consolidate to one price that you pay all at once. So let's say your grocery bill ends up being $100. The reason that this is a thing is because you don't want to have to go through the process of buying 50 different items separately, where you're then going to get 50 different receipts. And you also don't want to spend all the $100 of your groceries on just chicken because you want a variety of foods and drinks. So this same concept applies to index funds, which is why they're so convenient for nearly anyone to own, because you don't want to have to go out and buy 50 different stocks, and you also don't want to put 100% of your entire life savings in one specific company. So the idea here is that rather than going to buy foods and drinks from the grocery store, you want a variety of stocks that maximize your returns yet minimize the risk of losing money. Now there are many different types of index funds that you could purchase. The S&P 500 is one of the most popular ones, and it pretty much means that you're able to buy 500 of the largest US companies all within one purchase where you can easily gain access to this through a popular option like the ETF through Vanguard, that is VOO. Or if you want more US exposure, you could purchase a total stock market index fund where you would gain access to nearly all publicly traded companies in the US that range from really small to large cap size companies, where a popular option here through Vanguard is VTI. Or if you also want to gain additional access to companies that are based outside of the United States, you could look into an international fund with the ticker VXUS. I'll mention more throughout the video, but understand that when it comes to investing into index funds, they're actually very cheap to own. This is also known as the expense ratio, and is going to be the fees that you pay over time. So with an ETF like VOO, it would have a listed expense ratio of 0.03%, which means if you have $10,000 invested, you will pay $3 per year in fees, which this is something that's automatically going to be taken out of your investment over time. It's not something that you're going to have to pay separately. The reason that the expense is so low is because index funds are passively managed, which means there's no fund manager that's actively picking stocks, where the indexes for these funds are actually computed based on algorithms. Besides that, index funds are great for reducing risk because of the diversification that they come with, because if you invested into one stock or 500, if one company were to go bankrupt, this one would not make you happy, but this one you wouldn't even notice. On top of that, index funds are extremely easy to purchase. It only takes a few clicks of a button, and with the right investments, they have statistically proven to build tremendous wealth over time for investors. And based on the historical performance of the S&P 500, that has averaged a roughly 10%, not including inflation, but if that were to occur over the next 30 years, and you have absolutely nothing today, and start investing $500 per month, that means after 30 years, you would have just over $1 million. So now that you understand stocks and index funds, before you actually start investing, you have to know what type of accounts that are out there that you would actually want to consider using. Because of how important this is, here are some of the best accounts to consider. Now I'll quickly summarize the benefits to each of these accounts, but if you want to learn more and check out other videos that I've created, similar to the stock market, I've made many videos on my channel, and I'll leave some of the most relevant videos I believe could greatly benefit you linked in the description of this video and every other video that I create. But the first account I'll mention is an employer-sponsored retirement account. The most popular one is a 401k that your employer may offer to you. They'll have specific investment options available to choose from, and they may offer a contribution match where they will add more money into the account depending on how much you contribute. These accounts offer tax advantages where a traditional 401k allows you to invest upfront and deduct taxes on the amount you contribute, and then from there, during the years of investing, you will be able to avoid taxes as well, but then on the back end, you're gonna have to pay taxes at retirement. But something extremely important to understand for a majority of you is a Roth 401k, which is becoming more popular as more than 90% of 401k plans now offer the Roth opportunity, but only 21% of workers take advantage of it. The reason a Roth account is so beneficial is because if you have years ahead of you to invest, which is the majority of you, with a Roth, although you do have to pay taxes on the money up front, as you invest throughout the years, you're able to avoid taxes, and on the back end at retirement, you do not have to pay any taxes at all. So after compounding your investments over time, seeing massive growth, on the back end, you would ideally want to avoid taxes. And just know that with the 401k, as an employee for the year 2025, you are able to contribute up to $23,500. So while speaking of traditional and Roth accounts, my favorite all-around account that nearly anyone can greatly benefit from is an IRA, which stands for Individual Retirement Account. With this account, you can contribute, invest, and control the investments inside of this account however you want, similar to a normal investing account. But with this, you are limited to contribute among all types of IRA accounts for the year 2025, $7,000. But to exaggerate the benefit of an account like the Roth IRA, that is my absolute favorite. If you are 20 and hit the max contribution every year and average the stock market return, by the time you are 60 and eligible to withdraw, you could have a portfolio worth $3 million that is completely tax-free and could last you a lifetime. Yes, I know that sounds boring and very far away, but before you know it, time's just gonna go on, and if you don't take any action, you're gonna wish that you had started sooner. Aside from IRAs, another account that is extremely important to utilize if you are able to do so is a health savings account, also known as an HSA. Although it says savings account in the name, you can actually invest into an HSA, where it's reported only 9% of health savings account owners invest a portion of their funds, where the rest 91 hold cash. So the reason that this account is so beneficial is because it is a triple tax advantaged account, which means the money you contribute into the HSA, you get to avoid taxes completely. During the years of investing in the account, no taxes, and on the back end, you don't have to wait until retirement. You could use it at any instant that you want. As long as it is for a qualified medical expense, you get to avoid taxes completely on all three areas. Unfortunately though, this account is not for everybody because you do have to be enrolled in a high deductible health plan that is eligible for the HSA. But if you can take advantage of it, it is extremely beneficial and is why currently they put a contribution limit to it of $4,300 if you were single in the year of 2025. To prevent this video from being super long, the last account I'll mention is a typical brokerage account, which is a normal investing account where you can buy or sell stocks, index funds, or any other securities where there's nearly no requirements at all compared to the previous accounts I just mentioned that have contribution limits and you have to wait until a certain age or use it for a qualified purchase. But understand that if you know what you're doing, you can still benefit from great tax advantages even in a normal taxable account. To invest wisely here as far as taxes, if you are to hold a stock or any sort of security for more than 1 year, you are able to reap long-term capital gains, which means you will be taxed in the brackets of 0, 15, or 20%. So from the example that I mentioned earlier of Apple stock of buying in January and selling in December of the same year, that is not more than 1 full year of owning the stock. So that would actually be taxed as a short-term capital gain, which means it's taxed in the same bracket as your ordinary income. So depending on your income and how much you actually trigger as far as capital gains, the difference could be substantial. With that said, let's now go over exactly how to invest. To start this off, you first have to know what investing platform or platforms you want to invest on, which I'll have a link in the description below to some of the top options in the market. I will say if you do get started with one of those through my links, I may earn a commission for it, which is greatly appreciated. But to create an account, all you have to do is fill in your personal information, and then with a few clicks of a button, you would be able to deposit money from your bank into your account. Knowing that, I'll first go over how to do it on the app SoFi, and then I'll show you how to do it on the desktop version of Fidelity, which many of these platforms, the concepts to buying and selling and actually investing on the platforms is going to be extremely similar. So on the main page, and you'll see this similar to many of the other platforms, you can see the total amounts that you have in the account, whether that be banking or invest. You can see if you click on the arrow what kind of investing accounts you have. You may only have one if you just got started, but what you're going to want to do is either click on the investing account that you want to invest on, or you can click the tab on the bottom right that says invest, and then you'll be able to see your entire portfolio of all type of accounts that you have. And the biggest thing you need to know about investing on the app is the magnifying glass, because that'll be the easiest way for you to search a stock and then start buying it. So if we click on that top right magnifying glass, you can search stocks, funds, and other options. Many of these platforms will allow you to see like other news, research tools where you can learn more about other opportunities. But let's just say that you know what you want to invest into. First, know that each stock or index fund or securities will have a ticker symbol. So if you know what that symbol is, you could search that, and that would be a much easier way to just find directly what you want to invest into. So if you click on that search bar, you can see Apple is the recent one I searched, and the ticker is AAPL. But let's just say that you wanted to invest into the S&P 500, and you wanted to type it because you didn't know the ticker of the one you wanted. Well, it'll show options, but what if the one that you're thinking of isn't on here? The one that I'm thinking of is VOO, so I'm going to search VOO, and that will pop up right here as the Vanguard S&P 500 ETF. And you can click around to learn more about like the performance, and if you scroll down, you can see more about, its dividend yield, top holdings, so Apple's 7.2% of the entire fund. You can learn a lot more. I made many more videos on this if you want to check them out, but I'm going to show you an example using Apple. So let's just search AAPL, and then you'd see it, and then you'd click on it, and it would pop up. The easiest thing that most of these platforms are going to show is this trade button on the bottom right. Click trade, then click buy or recurring. If you're doing recurring, it's pretty much going to allow you to do it on a frequency basis. Every week, every 2 weeks, every month, it would automatically purchase Apple stock depending on how much you do and how you select it. Going back, let's hit trade, then buy. The thing I like about SoFi is that they keep their platform very simple. So if you click on the top right, you can see right now you could input with dollars, or you could do it by shares, or you could do a limit order. If you click dollars because that's the simplest one, let's just say that you want to buy $100 of Apple. You can do this as a fractional share. $100 of Apple right now, it's trading at $242. The estimated shares is currently 0.41. If you click review, then you look it over all one more time, make sure it's the right account you want to purchase it in, then you would hit submit and that order would go through. And if the market's open, it would go through instantly. If the market is closed and you do a market order, it will not go through until the market opens next. All right, the next thing I'm going to show you is how to invest using a desktop platform. I'm going to use Fidelity for this example, but know that many of them are very similar. But whether you're on the web or a platform's app, the most important thing you need to do is find the search bar so that you can find the exact investment that you want to invest into. For this case, I'll change it up from Apple and we're going to do the S&P 500 VOO. Search that, you'll see it pop up, you'll click on it, you'll see a ton of data, and on the desktop you can see even more, and it's much simpler to click around, at least in my opinion. Scroll around, you can learn a lot about it. I know I want to buy this, so I'd hit buy. If I already owned it, I could click sell, but I could also see the investment in my positions tab of all my investments in my portfolio. If you click on there, you can also get to this page where you could then click sell. Let's just say I want to buy it, I'm going to click buy. It's going to be a little pop-up right here, which is nice. Then you can see that. You can select the account, the symbol to confirm the price of the S&P 500 index fund that we want to buy. If you click on this little calculator thing right here, you'll see the dollar amount that you could input. Let's say that you wanted to buy $300 of the S&P 500. That would be roughly just over half a share of this ETF that is trading at $536. Let's hit apply, but see that it automatically put into a limit order. If you change that to market, that will allow it to instantly go through, assuming that the market is open. If you want to learn more about the different types of trades that you can make, I made an entire video on these that I think you could really benefit from, and I'll have that linked in the description below. So now that you understand how to buy a stock, let's now go over how to build a portfolio. Although by no means am I a financial advisor, but there are a few guidelines to consider when it comes to building a portfolio, with the first one being the 110 rule, which means you take your current age and subtract it by 110. Whatever the number is that comes out of that is the amount that you would have in stocks compared to bonds. So let's say you're 30, you take 110 minus 30, that's 80. You may want to consider 80% in stocks, and then the rest, the 20% of your cash, in bonds or other fixed income securities. With future expenses like a wedding, down payment for a house, and many other factors to consider, having your cash safely earn interest is extremely important for your finances. But the nice part about the 110 rule is that it allows those that are younger the ability to take on more risk with growth investments in the stocks, and then as you near retirement, you gain the ability to build a safety net. After understanding how much you may want for stocks compared to bonds, you then may want to ask yourself, what amount would you want going to domestic stocks, foreign stocks, then toward your bonds. Just to give you a generic example and throwing out numbers for you, let's just say that you're 30 and very aggressive. The number for domestic stocks may be 80%, then 10% into international stocks, which is foreign, and then 10% into bonds. And then from there, you're going to want to pick the exact investments that go into each category based on your own needs, such as overall risk and potential growth that you are looking for. For example, let's say that you want to keep things simple and get a total stock market index fund like the ticker VTI. This would be a foundation to a portfolio, and you may want to have 50% of this alone inside of your portfolio. From there, since you are aggressive, you may want 20% in a large cap growth index fund like Charles Schwab's SCHG or Invesco's QQQM. And say you want a more stable investment with a potential dividend income, you may want to consider an index fund like Charles Schwab's Dividend Equity ETF SCHD that only has an 8% overlap with the S&P 500. So with this, you're diversifying away from all the heavy tech stocks like Apple, Microsoft, and Nvidia. From there, you may consider 10% toward the foreign stock category, where you can gain international exposure outside the US with Vanguard's ticker VXUS. And then for bonds, you could consider a bond fund like Vanguard's BND, but personally, rather than bond funds, I prefer to look at fixed income securities like CDs or US Treasuries, where you can get a guaranteed rate over a specific period of time. Please understand that these are just generic numbers. Everyone has their own positions that all differ, and you must make your own financial decisions. But to have the highest chances of succeeding in the market, here are some of the most common mistakes you need to avoid. The first area is timing the markets, where one of my favorite quotes by the billionaire fund manager Ray Dalio is when he said, trying to time the stock market is harder than competing in the Olympics. Not just does it sound hard, but the legendary investor Warren Buffett turned a $318,000 bet into $2.2 million from betting with hedge funds that a simple index fund would outperform actively managed funds. But of all the advice from successful investors, the simplest one I love to view is from John, also known as Jack Bogle, who is the founder of Vanguard, who said, don't look for the needle in the haystack, just buy the haystack. The motto here is that with strong index funds, they are going to be your best bet when it comes to building a strong portfolio, and that is because historically it has proven to do so. And if you're tracking the US economy and the country continues to develop, then so will your investments. Besides that, another mistake is the waiting game, where you say you'll eventually start investing in the stock market, and then a week, 2 weeks, a month, and then a year goes by. When it comes to investing in the stock market, the easiest thing and best overall option for majority of you is to just make sure that a specific amount of your paycheck is going into the market every single time you get paid. Besides that, another thing you have to make sure of is having an emergency fund or any sort of cash saved where you do not have to pull from your investments in the worst case scenario, because if the market's down, that would be the worst time to sell. The best place for an emergency fund or any liquid cash that you want easily accessible would be a high yield savings account, which I'll have a link in the description below to some of the top options in the market that you may be interested in getting started with. And I know I mentioned index funds a ton, but if you rely on only a few stocks with your entire life savings, if something bad were to happen to those companies, or even one of them, your financial future could be in for some serious trouble. As I mentioned, investing into particular companies, be aware of the hype when it comes from others, because many times when it's too good to be true, that's because it is. The last mistake to avoid is excessive fees, especially if you are investing into actively managed funds where the expense ratio is between 0.5% to 1%, and you don't even realize it. It may not sound like a high percent, but the difference over a long period of time compared to a low-cost index fund can be significant. If you want to learn more about investing into the stock market, I highly recommend you check out the videos that I've created on this channel, which I'll leave the most relevant videos that I think you'll find the most value from linked in the description of this video. And while you're at it, I think you'll find great value from my free learning guides that I've created, whether that's building a portfolio, learning about the stock market, or my index fund cheat sheet, high yield savings accounts. I think you'll find great value from these. And as I mentioned, if you do want to start investing into stocks, I'll have a link in the description below to some of the top investing platforms that you could consider, which depending on the platform you choose, if you use my link, I may earn a commission for it, which is greatly appreciated. And lastly, if you want to see exactly how I allocate each of my investments and other exclusive content, consider checking out the Patreon that I'll have in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.